Over the last few days, we've had nonstop social media posts and news posts and hearing everything everywhere about this 1.99 fixed rate. And for good reason. It's the lowest advertised fixed rate we've ever seen in Canadian history. But did you know there are a lot of other things you should consider when it comes to these low rate options? There's a lot of solutions. And we're going to break down one of the key considerations when it comes to actually looking at this fixed rate mortgage. Is it right for you? What you should be looking at and more. So guys, if you're liking this podcast, make sure to share this with your friends, subscribe, give us a rating, and send us a message. Let us know what you think. I hope you enjoyed this episode, and we'll talk to you soon. What's up, guys? You are listening to the YVR Remo Show, where we talk all things Vancouver real estate and mortgages, take boring topics and make them interesting. Make sure to stay tuned to listen to everything you need to know how to put cash back in your pocket, create wealth in real estate, and simplify the complicated. Today, we want to start off because the number one thing that's been in the news is something that we've talked about a lot over the course of the last 3 or 4 months. And it's something we talk about every single day, which is interest rates. I've seen posted, I don't even know, like 20, 30, 40 times over the course of the last week, HSBC 1.99 rate. It's really making a lot of people pay attention and listen now. Even though interest rates weren't dramatically higher over the course of the last week or two, just that 0.1% under 2 is just, it's calling a lot of people to make a move, either buy a property or refinance or things like that. So the reason that we're doing the show here today is because it's a conversation that comes up a lot. And a lot of our conversation comes down to strategy. And a peer in the industry, Mr. Dave LaRocque, took the time to put together a fantastic article, and it broke down all the things that we talk about quite frequently. And we wanted to basically shout out to Dave and spend some time dissecting the information that he put in here. So
yeah, I mean, it's a typical spring market rate sale, right? So we're essentially in this delayed spring market because of COVID, and this is typical. Usually, one of the big banks comes out with a fancy new shiny product that catches everyone's attention, and HSBC was the one that stole the attention this year, and 1.99% fixed interest rate. I think that's the lowest we've ever seen.
Yeah,
in my experience, it's the lowest I've ever seen. So, yeah, it's got everyone's attention. It got our attention, and that's why we're talking about it.
Yeah, most people, like, when they come to a mortgage broker or their bank, they're going there and they want the best interest rate. Like, that is what everybody's focus is when they're, especially first-time buyers, because that's all that they know. And to no fault of their own, it's the only piece that's really marketed in regards to a mortgage, right? So we take a lot of time and break down the minutia of what's behind that. And sometimes, actually, probably 99% of the time, the best rate is not the best product.
Yeah.
I tell pretty well every single one of our clients that I am not going to get them the very best rate, but there's good reasons behind that, right? All the stipulations and additional costs and restrictions that can come with these low rate mortgages, which is what we wanted to break down today.
Yeah, it's definitely making waves. It's making the rounds. It's a conversation that comes up. But funny enough, I think people are starting to, at least some people that have had a mortgage, I find that people who have already had a mortgage in the past have felt the pain of something happening. And, I had a conversation an hour ago with a guy that said straight away, I understand there are some other considerations, so I'm okay to suggestion on that point, which is awesome to hear. But a lot of people don't know that. And so let's deep dive into it. I mean, let's be honest here. We're not picking on one bank or another. There's a lot of banks that have these different types of terms and conditions that you got to pay attention to, the T's and the C's, as Dave would put it here. And again, without going too deep right off the bat, let's just jump into some of the reasons why this specific product, when compared to some of the other ones out there, may not be your best bet. And when I say that, and I'll pass the baton over to Dean or Derek here, when I say that, I want to be clear. The other options that are out there are not dramatically higher. Like, there are a lot of lenders that are right within 0.25% or so of this interest rate. But I think a lot of people may miss the boat and not knowing that just because they're just looking at that advertisement, right?
Yeah. And to your point, not to pick on HSBC, every lender has a very similar product to this that has almost the same rate or just above. It's what is attached to the product. There's significant restrictions that are attached to it, and before anyone takes one of these products, they just need to understand what that is, because in some cases this product may make sense for you if you are aware of those restrictions and you know that they're not going to impact your future. But it's really hard to understand what's going to happen. It's hard to predict the future, right? Like anything can happen. Life changes, loss of job, all these sorts of things that would force you to have to make a change in your mortgage midterm. You're going to want to be aware of what these restrictions are. And I think maybe we should just start talking about those right now.
Well, the biggest pitfall that comes with these really low rate products is the penalty if you were to break the mortgage early. So it's called a prepayment penalty. Essentially, if you take a 5-year fixed mortgage, you're committing to 5 years with that bank at a certain interest rate, right? So the bank expects to earn a certain amount of interest off of your loan. Now, if you're going to break that mortgage early, there's penalties to do so. And everybody going into their first home, they say 100% I'm going to be here for 5 years. Like I'm going to be here for the rest of my life. But I think the stat is that the average Canadian breaks their mortgage every 3.5 years, right?
Yeah.
For so many reasons. One perfect example right now is our interest rates have dropped dramatically. And I personally, this is a personal experience, I have a 3.3% fixed rate mortgage, and I wanted to move it into a 2.2% variable, and my penalty is $23,000. So I'm restricted from gaining that savings, right? That's just one perfect example. A lot of people are being held back. They can't move into a cheaper product. People need to sell, they want to upsize, people change jobs, whatever the situation might be, right? People need to refinance and pay off debt. We help a lot of our clients break their mortgage within term for good reason, but if the penalty's there and it's too dramatic, sometimes it doesn't work.
Yeah. So in this scenario, so again, we've got a few scenarios to run by. We've got a scenario where we have a lender at HSBC's option. And actually, before getting into the scenario, I think there's something that a lot of people might be missing here. Even with HSBC, a lot of people do not qualify for this option, this product. To be clear, this is for a high ratio. You pay for the insurance mortgage product. So that's an important note. Like if you're putting down 20% or you're doing a 30-year amortized loan, you're not likely going to qualify for this option. It's going to be a higher interest rate. So let's just put that straight off the bat.
There's one significant restriction to some of these products that lenders offer, and it's a bona fide sale clause, which means you can't change lenders with that same property. You have to sell the home to get out of that mortgage, and then you still pay the penalty. So that's a significant. That's significant. Like you need to know that.
In this scenario that we're looking at right here, I think there's when we're looking at this actual product and this interest rate, just comparison from one to the next. We have one rate option at 1.99 and one listed here at 2.13. And to be honest with you, some lenders are 213, 219, 229. There's a variety of different types of products out there, but we're using this 0.14% difference. For a loan amount of $400,000, the difference in payment is $27 a month, right? So that works out to basically $12 biweekly when you spread it over the 26 biweekly payments. The total interest over the course of 5 years is $2,600. Like obviously it's something, but let's just look at the comparables. So one thing that I found really interesting when considering this solution is that we're actually not likely at the bottom for interest rates. We're not at the rock bottom.
Yeah, and just on that, it is June 19th, 2020 today. This is when we're recording it. So these rates could obviously change. The rates could be lower by the time you maybe hear this. I mean, we're live right now, but when this episode gets released, the rates could be lower, to your point.
Yeah. So when you consider putting yourself in a situation where you're locking yourself into any fixed rate, one of the suggestions I make to any one of my clients is just keep in mind, you are paying often for that comfort. You're paying for the comfort of being locked in. In a rising interest rate environment, it could make sense because you're protecting yourself. But if we look at where things are economically and knowing that in Europe last year, we went into negative interest rates, we're actually our clients are paying a surplus on where they should be right now. So locking in today might not make sense purely based on the fact we're actually paying more today than we should be.
Yeah, and the premium that you're talking about is due to COVID, of course, right? And risk to the lenders, because if you looked at it, where interest rates technically should be, they should be in the 1% range, and we're kind of low 2s to mid 2s right now. So there is a buffer in there that could absolutely diminish as time goes on, depending on what happens with our economy and COVID and second waves and everything that comes with that.
Yeah, we're like, again, like you mentioned, like typically we would see 1.25% above the bond yield for your average fixed year rate. So if you're trying to understand what that looks like, look up the bond yield and look at about 1.25 to 1.5, depending on the lender and their personal risk. But we're seeing about an extra 0.37% above that right now, as you mentioned, because of COVID risk. So if we see that start to melt away and we see the market continue to pick up and the economy start to move back again, we could definitely see interest rates start to fall. So if you're locking in today at that low fixed rate mortgage, keep in mind, we definitely, and it's almost highly likely that we're going to fall again. So you're basically now paying for the comfort, but you're putting yourself in a situation where if rates did drop to 1.5%, you're actually paying even more for that. And if you were looking to refinance, again, that penalty is going to come into play again.
Yeah, the simple picture historically, where rates should be today is around 1.6 to 1.75. Like that's historically the threshold that we should be looking at. So yeah, like it is very likely we're going to see another drop in the fixed rate term.
Yeah. So looking at the actual penalty conversation that we have with clients, I mean, there are some people that are certainly staying. One thing to make a note of is if our clients are taking a variable rate mortgage today, which we've seen the discounts actually widen and get better over the course of the last few weeks, a variable rate mortgage typically has a maximum penalty of 3 months of interest. Now, do keep in mind there are, we call like McDonald's of mortgage options, the low frills solutions out there too. But you know, the variable rate avoids all of that. So if you're listening to this and you're a variable rate holder, then generally speaking, you don't have to stress about any of these types of information. But jumping back to the fixed rate, why don't we just kind of run through some examples of maybe different types of lender calculations as far as interest rates are concerned?
Yeah, so why don't we just start with the one that we would consider the most advantageous, and that would be, I guess the product that wouldn't be considered a no frill. So this is a product that has the extra features, which we would consider definitely one of our top recommendations.
Like a full feature mortgage.
Yeah, full feature mortgage. So typically what would happen is if we assumed we had a 2.13% fixed rate and we fast forward 2 years into our 5-year term, we would have 3 years left in the term. And now we're deciding to break the mortgage for whatever reason. Say I'm moving, for example, trading up. How they would calculate the rate, this particular lender example, they would look at what the current 3-year fixed is, because there's 3 years left in the term. So that's essentially what they're comparing it to. So if we looked at today's 3-year fixed rate, that would be 2.39%. So the 3-year fixed rate is higher than today's 5-year. So we're assuming rates are the same. You're actually going to pay a 3-month interest penalty in this scenario with this particular lender's product, because the 3-year fixed rate is higher. So we in this case it would function like a variable, and we would only pay 3 months interest.
I think it's important to point out, and thanks for breaking that down. For anybody who's listening to this, we'll try not to go too deep on a lot of this, because it's something you almost have to see visually to break it down. But there's basically 3 different types of fixed rate mortgage calculations, basically, right? There are some low frills solutions out there too. A standard method, the posted method, and the discounted method. Out of the 3 options, if you're listening to this, if you're going fixed, you want the standard method. Like that's what you should be looking for or asking for from your broker or your bank. Now, typically, almost all banks use the discounted or the posted method, which is where you hear of these larger penalties. So using that calculation that you had mentioned, if we use the discount from an HSBC model, again, without going through that same track, that same type of product, but at 1.99%, if we were using HSBC's methodology, would be a $23,000 penalty. So instead of about $1,500, we're going to $23,000, which is, I mean, you just mentioned right away, 23 grand stops you from being able to refinance or save.
It's dramatic. Absolutely.
And that's assuming the mortgage balance would be $400,000. So yeah, $23,000 penalty with the 1.99 fixed rate.
Yep.
And roughly $2,600 with the 2.13% rate, assuming we're at the 2-year mark.
Yeah.
So there's a lot of assumptions in these calculations, and it doesn't matter who you sit down with or who you talk to. Nobody can calculate your penalty for you now
in 2
because
years, right?
it all depends on where the markets are at that time and where rates are, right? What rates are being offered, which is going to help the lender justify your penalty. So it's very, very hard to justify at the beginning or actually understand that cost. And no bank is ever going to break this down and show you what it could be, right? But making sure that we have that conversation, showing our clients the different options. And sometimes our clients say they're cool with it. They get it. Right.
Yep.
And they're okay with a big penalty, but they want that lower rate with TD Bank or Scotiabank, right?
Yep.
They want that. Another big thing to mention is if you are selling and buying another property, there's portability clauses if you have a full feature mortgage, right? So if you didn't take the low frills, low rate product, you have the ability to port your mortgage to another property to avoid that penalty.
Yep.
But I tell clients not to bank on that because there's a lot of scenarios where you can't port, right?
Yep.
I have some clients right now that are adding their parents and they're buying a property together. Because they're adding people, they're changing the mortgage so they can't port. So they're being hit with a penalty from their bank. Another situation was a client was buying a remediated grow-op, and the lender that held their current mortgage doesn't finance remediated grow-op properties, right? So they couldn't port as well.
Right.
But sometimes you do have the ability to port your mortgage and avoid that penalty, but it's just planning for the worst, right? And making sure you're with the right lender.
Totally. I think the winning point out of all of this is that there are like a lot of low interest rate options that are available. And typically when we see these options advertised, it's buzz, it's marketing, it's media. It's just like advertising the cheapest car. Like if you go to a car lot, I try to explain this to people all the time. There's like the price that you see on TV and the magazines, and then you get there and all of a sudden, well, why is my sticker price actually $30,000 or $20,000 or $15,000 more? The reality is there's a lot more behind the scenes, and this is an opportunity for a lot of these banks to make money really at the end of the day too, and keep you with them. So it's a product. They're there to make money. Don't make any bones about it. But like, definitely you want to dig deep. And if you're talking to your bank and they can't explain or at least give you an idea as to what your penalty could be, worst case scenario, you got a problem. Like, ask them that question every time. If you're working with us or you're working with another mortgage broker and you ask that question, maybe get a general calculation as to what that would look like or a comparable. These are things that you need to know and you need to consider definitely looking back. So I think it's definitely a key point.
Well, yeah, I think the example we just ran through, it's a $27 a month difference in payment each month.
Yep.
$27, like, to potentially have a $2,000 roughly dollar penalty or $23,000.
Yeah.
So it's like, would you pay for that little bit of extra insurance coverage? It's almost like an insurance policy. I guess you can wait. It's a good way to look at it.
Absolutely. So what is your total cost? Your total cost should not just be the interest. It should be the potential penalties. It should be the other factors. Guys, I think we just beat the hell out of penalties for the better part of 20 minutes. So
yeah.
Anyway, so listen, guys, if you have any other questions about the HSBC mortgage, any of the other lenders that are out there, why they're different, other kinds of costs associated with that, like, then that's really our job. That's what we do. So reach out to us or a mortgage broker that you trust, but just make sure that person's actually looking at all your solutions so they're taking care of you and you know what's going on.